Rohr here with an early global view on Thursday, June 18th, 2015. It's currently 7 a.m. U.S. Central Time, and it's important to note the Fed is still accommodative. And in our post today, we're going to review a bit of why you need to ignore all those indications from the FOMC members that there's likely to be at least one hike and maybe two this year. It's data dependent. Janet Yellen says so. That's it. So what has all this meant to the markets? Well, what we had is markets that were up out of Monday's crunch again. This is September S&P 500 future hourly on the left, 30-minute on the right. And we're looking at a market that actually at present is up 6 at 2,095. So getting back near the best level seen yesterday after the Fed announcement. But we'll review why this strength in the SEP contract is not quite as important unless it can get up to a new high for this rally into late week and actually close above 2,100. And we'll revisit that momentarily. But just as a bit of recent history, of course, last week and again this week, this contract dropped down around the 2067 level. As a matter of fact, started the week challenging it but couldn't stay down. That was important because the $8 discount relative to the June contract meant that the lead contract was retesting the low end of the important 2,078 to 75 area. Now, ratcheting back up, interestingly enough, back above we said it would have to get back above 2080 to 82 because that was an important lead contract level as well on that $8 spread. 2088 to 90 was a key. And therefore, even as it backed off yesterday, getting back down to 2082 to 80, once the Fed statement was out, the market perked up because it still was a bit more dovish than quite a few parties had been expecting. Now, we then had Janet Yellen's press conference beginning at just about 1:30 U.S. Central Time, and she also made the case why the indication from a majority of the Fed governors that there was going to be at least one hike this year and maybe two was really not real. It was data dependent. That's based on how they expect the economy to progress between now and September. Any weakness that shows up that adjusts that view means they won't be looking for a rate hike in September. So September's still on the table, but they've caveated the heck out of it with the idea that we are still data dependent. Now, what does this mean in technical terms? Well, this morning being up at 2095, up 6 on the September contract means at $8 higher, the lead contract is above 2,100. That's an important level, and we'll revisit that on the intermediate term charts. But what is equally as important is that lead contract expires today. End of business today. June S&P 500 future is toast. That means this contract, September, takes over as lead contract. And that's why we said the question is whether by tomorrow's close, this can be above 2,100. Now, you'll note also, based on the gap down coming in on the 12th, going back to last Friday on the Greek concerns, in spite of some decent data, this gap down from 2101.40 on Thursday's close. And that's going to be a fairly big decision as to whether this market is back above that gap at 2101.40 in order to push higher. It's also important whether it pushes higher right now on another level, which is the short-term indicators. If it pushes up a bit more, the hourly MACD might either stall at or leak out through the upper runaway band. If it's well above 2,100, this is going to start to signal the ability to sustain strength again. It all works hand in glove with the broader technical levels. And that pretty much does it for the short-term view of the June S&P 500. Pardon me, the September S&P 500 looking to become lead contract as the June goes off the board.